Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken. Our model portfolio is up 0.09% year to date. And we have a green for the S&P 500 stock market strength color signal. And the S&P 500 buy and hold investor is currently up 1.5% year to date. So they had a really good week last week, and I'll show you that as we move through the presentation. Here are some past results for our model portfolio. Last week, the S&P 500 gained 1.21% for the week. And we'll go through the charts in much greater detail later on. We recently had 9 weeks in a row up, only one down red week, and then 2 more green candles, just to show you how strong this market is. We did make a trade during the week. So on 117.24, we did 1 cash secured put. I didn't even want to do 2 cash secured puts, although I had the funds available to do that. So we got some money for our portfolio. So here is that exact second trade that we made for the year on 117.24, and we put an additional $44 in our pocket with that trade. So here's where we are at right now. Here is our equity curve for the model portfolio year to date. Here is the equity curve for the S&P 500 buy and hold investor year to date. And here are the 2 equity curves combined. So we were doing okay up until last week. Last week is when the S&P 500 just had an extremely strong week, and I was more conservative. I'm probably too conservative right now, and I'll show you that. Here is the Fed Chair, Jerome Powell. The last Fed announcement on December 13th was a skip. The next announcement, which is on January 31, are we going to have a 25 basis point rate hike or a skip? I don't know what the odds are right now. So we'll wait and see what happens. We're a week and a half away from that announcement. Now we're looking at things from the presidential election cycle theory. Depending upon the year of the election, you have historical rates of returns. This is for the S&P 500. This is for the NASDAQ 100. President Biden is in the 4th year of his term. Historically, that is a 6.7% return. Right now, the S&P 500 is up 1.5% for the year, meaning there's plenty of room left, about 1.7% left in order for this market to continue to advance. Okay, now we're looking at things from the bond market. The bond market is 4 times the size of the stock market, so we want to listen to them. And right now they're saying to stay out of the stock market, but they've been saying it for a while. We're watching the yield curve. We have an inverted yield curve and we have rising interest rates. These are the 2 prevailing reasons why the bond market is saying to stay out of the stock market. Here's our friend Warren Buffett, the Oracle of Omaha. We are currently, according to CNN Business, on the Fear and Greed Index at 72, last week 71. So we're hovering at the heavy end of greed. Now we're looking at things from a seasonality outlook. These are monthly bars for the S&P 500. Currently for the month of January, we are up 1.5%. And in the month of January, historically for the S&P 500 going back 20 years, there's only a 45% probability, less than half, that you're going to close the month higher than when you opened it, which is not good odds. But right now this market is bullish. Right now this market is up. Now historically, the S&P 500 averages somewhere between 7 and 10% annualized. Currently we're up 1.5% for the year. Plenty of room for advancement in the S&P 500 between now and the end of the year. Now we're looking at things from a long-term outlook. These are a monthly 20-year chart for the S&P 500. Long-term bull run, correction, broke out, never looked back, and still going strong. This bull market is still intact since 2009. Now this is an intermediate term outlook, weekly, 5-year chart. S&P 500, I see a negative divergence. We had it last week, we have it this week. You have higher highs on the price chart and a lower high on your MACD. That's a negative divergence, normally followed by price slowing down and coming back down. This correction that we had, you can't even call it a correction pullback. I mean, it's basically nothing. So this market is either doing a blow off top, or we have such a strong market that this is going to continue to advance. And we just broke out to new highs. Here you can see where we broke out on that last candle, and look at this, we broke out on Friday with volume. Breaking out with volume is positive. The MACD is coming down, but it is curling up, ready to go above its signal line. Slow stochastics is already above its signal line. This tells me we have more bullish activity in the short term ready to go. Now, I put down in my charts for last week, MACD is dropping, overextended above the 50. The distance between the actual price pattern and the 50-day moving average, I thought was a little high. I thought it was going to come back down so that the two would get a little bit closer and come down, because the 50 acts like a magnet. But this market is breaking out. MACD is poised to break out to the upside. So I put in a Fibonacci retracement, 38, 50, and 61.8. We never came nowhere near the 38. So there is absolutely no pullback in this market, and it is still advancing up. What do I see? I see a high, I see a low, I see a higher high, I see a higher low. Now I see, as of Friday, a higher high. So that should technically be followed by a higher low. So we should potentially come back down to the higher low, find support around 375-ish, and then advance. Okay, now this chart here is how I was trying to demonstrate how extended the MACD was going back 20 years. And I was looking for a pullback like we had here, like we had here, like we had here. We are not getting that pullback. So we want to be on the right side of this market. Now we're looking at a risk on indicator ratio chart, NASDAQ against the S&P 500. And right now, the risk is on. This support line here is not broken. We are in this trading range, and so risk is on in this market, even though we have a negative divergence even on this chart. Higher highs, higher lows on the lower lows on the MACD. Okay, now we're looking at another ratio chart with the equally weighted against the normally cap weighted S&P 500. We have a topping pattern and we're coming down, meaning that the RSP, the equally broader market, is not as powerful as the narrow cap weighted S&P 500. So with this coming down, the S&P 500, the cap weighted index, should be stronger than the equally weighted S&P 500. Now we're looking at the fear index, the VIX, and there's three ranges: ultra low range, the low range, and this upper range. We are hanging out in this ultra low range. And what does the market do when it hangs out here? It goes up. It goes up. So we need to be going more long this market. I've been way too conservative in last year, and that's why my results did not even match the returns of the S&P buy and hold investor for last year. All right, now we're looking at Thinkorswim platform, and we have a 5-year weekly chart with standard deviations, +2, -2 in gold, +1, -1 in pink, regression line in the dashed green. Here's some information about standard deviations. We currently reside at the 0.2 standard deviation on this chart, giving you plenty of room to fall in either direction. There was your old high, and here you can see that we broke that old high as of Friday. Now we're looking at the same chart, but instead of going back 5 years, we're only going back 1 year. On this chart, the standard deviation is at 0.7. There's a 68% probability that when you hit the 1, you begin to flatten out to come back down. So the higher you go, the odds favor less room for advancement, but there's still some room for advancement in this chart. Now we're looking at the same thing, but we're going back only 6 months. Now on this chart, you are already at the plus 1.2 standard deviation. It could still continue higher, but the probabilities are reduced above the +1, and this is a 6-month chart. We did hang out above the +1 for some time way back when over here, but not much in between. Well, this is where we're currently at right now, but the MACD is poised and ready to continue or stay in this upper area. What I've done is I've done an asset classes. These are different asset classes. These are the 11 sectors of the S&P 500. And last week, all the asset classes were at 73. This week, we're at 75. So brought more strength against multiple asset classes. The 11 S&P 500 sectors last week was at 82. This week is at 77. So it softened up a little bit amongst the sectors, which is interesting because the S&P 500 advanced last week. But we're still green in both of these, all things considered. Now we're looking at a 1-year chart of the 10-year bond yields. What do I see? This is the 50-day moving average. And see this candle? This candle shows you how the bulls tried to run it up, but the bears ran it back down. I see this particular 10-year, one-year chart of the 10-year bond yields, symbol TNX. I see it bouncing on the backside of this 50-day moving average and coming back down. And what happens when bond yields go from here to here? The S&P 500 goes from here to here. What are you going to do with all that information? Now comes our critical thinking. As of January 20th, 2024, the market summation, according to me, Ken, your friendly host with SPY Trader Now. The market just broke to new high ground, which indicated more upside is coming, but the market is still overextended. The pullbacks I have been looking for are so shallow that it suggests a very strong market. I don't want to put on leverage at this juncture because we're too high, but I will sell at the money cash secured puts for some income. So this is the exact trade I'm going to look at taking on Monday when the market opens. I'm going to be looking at selling 2 puts with a 478 strike. I'm going to get 96 cents. When I put that in my cash secured put calculator, which by the way, if you would like one to have this calculator for free, just head over to my website here. There'll be a link in the description, and you can find it there and you can download it for free. But this particular cash secured put is going to return for us an 18.36% annualized return on investment. If we get exercised, we're going to pick up the S&P 500 at a 1.12% discount compared to its current trading price of 482.43. So I'm willing to accept that for this market, for this strength, for that return. I will take that trade. So that is my expectation for next week. So I hope you've gotten some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, and since you stayed with me to the end, do me a solid and smash that like button down for me right now. I thank you, and I wish you good trading.